Good afternoon. This is Tim West, Sales Director here at ClearBridge. I want to thank you all for tuning into our AOR webcast. I also want to thank those of you that have already sent in questions and to encourage others to send in questions via the Q&A tab on your computer. We'll attempt to address as many as time allows, and we'll follow up those that we don't have a chance to address during this hour at a later date. Before we start, I want to recognize all of the military veterans on Veterans Day. We thank you for your service and sacrifices. Please join me in welcoming Jeff Schultze and Josh Jammer. Jeff and Josh provide tremendous insight and clarity on the state of the economy. Every time I have a question for one of them, they always seem to provide a chart to support their answer. I do not know how they do it. Before we start, there's a couple of issues that I wanted to address. One of them, Jeff, Josh, everything in 2020 seemed to be unprecedented. Yet here we are in 2021, and the word seems to be transitory. Maybe during the course of your chat, you'll share your thoughts on those two expressions. But Jeff, Josh, it's all yours.
Great, Tim, and thank you everybody for joining the fourth quarter update here. For the anatomy of a recession. And obviously, we've seen a lot of action in the third quarter, and I think maybe one of the most notable things that we saw in Q3 was a large deceleration of economic activity. We went from 6.7% GDP growth in Q2 all the way down to 2% in Q3. And although that's a huge deceleration, the good news is we think that a recession is nowhere in the cards for the next couple of years. One of the reasons why we say that is the ClearBridge Recession Risk Dashboard. Again, a reminder, 12 variables that have done an excellent job of foreshadowing an upcoming recession. And for the first time in a long time, it's not entirely green expansion. We finally got some color in the dashboard with wage growth formally turning yellow at the end of October. Now, the reason why wage growth turned yellow is in the most recent jobs report that we got, it came in at 4.9% year over year. That was stronger than anything that we saw last cycle. But from my vantage point, if there's one to turn yellow, I think wage growth is a good one because it tends to be one of the longest leading indicators, usually turning red anywhere from 2 to 2.5 years prior to an actual recession. But I also think wage growth is going to be unique this cycle. Usually, when wage growth turns red, it stays red for the remainder of an economic expansion. And this time around, I do believe that there's going to be a lot of labor supply that comes online in the next couple of quarters, and we could see wage growth move back down into the low 4% range, bringing it back to green overall. But nonetheless, we still have our first color in the dashboard in over 4 months, but the overall expansion color is still very much a green signal. Now, to go into one or two other quick of the indicators, one of them that I've been watching very closely is initial jobless claims. This is one of the best indicators we have in the dashboard. It's one of the highest rated and highest weighted because it's usually the last one to turn red before a recession. Usually when the initial jobs claims increases by 10% on a year-over-year basis, you're near a market peak and you're starting to see the economy decelerate. Now the good news is yesterday we got an initial jobs claims number at 267,000, which is a post-pandemic low, and the 4-week moving average, which is what we look at, is at a post-pandemic low as well at 278,000. So they continue to see strength in the jobs market overall. So again, the recession risks are low right now, and quite frankly, you're seeing a reacceleration of economic activity. And one of the ways to gauge this is by looking at the City Economic Surprise Index. It looks to see whether or not the economic data is beating or missing consensus expectations. And we got back to trough levels in the early part of September, and since then you've seen a drastic reacceleration. And I think you're going to see economic activity be quite robust in the fourth quarter, going back to levels that were seen prior to the impact of Delta. Now, this slide may look familiar to a lot of you. We introduced it about 2 quarters ago, and it shows you that manufacturing PMI is a really important economic data point. On the left-hand side, it leads GDP by 2 quarters, and our view has and continues to be that we're going to be in a period on the right-hand side where you have manufacturing PMI that's high and stable rather than high and decelerating down. When you see a deceleration, a V-shaped deceleration, it's usually bad for the markets. But we were at a peak of manufacturing PMI at 64 back in February. Today, we're at 61. So you've seen a slight deceleration, and at 61, that's consistent with real GDP growth. of 6%. So it's core to our view. You're going to see the economy reaccelerate and be strong over the next couple of quarters. The other thing I'll mention is GDP Now. If you look at the Atlanta Fed's nowcasting tool, that has fourth quarter GDP coming in at 8.2% on a real basis. On a nominal basis, if you add 5% on top of that, including inflation, fourth quarter GDP can come in the low teen range. Now that's a huge number, and again, a good sign that economic earning, the market's earnings can continue to surprise to the upside. But the economy appears to be moving past Delta. The other thing that people are concerned with right now is the fact that you're seeing a large deceleration in consumer confidence. You're looking at the Conference Board survey, and when you've seen a large deceleration of this magnitude, as long as it's non-recessionary, it's actually been a good environment to own equities. Your average one-year return has been 15.3%, and the market has been positive in each of these 6 instances. And given the strength of the ClearBridge Recession dashboard, again, we think the possibilities of a recession right now are pretty remote. Maybe more importantly, if you look at the Conference Board survey, it increased by 4 points in October, so it does appear that the trough has already been in. Now, if you look at the University of Michigan survey, which is the sister survey from a confidence perspective, it's not moving up at the moment, but it does appear to have stabilized at 72. And whenever the University of Michigan survey has been below 72, your average 12-month returns looking forward has been 11%. So obviously, people have had sticker shock. That's one of the reasons why you've seen a drop of confidence. But the other reason is, of course, that Delta was bringing down economic activity. And now that we're past that, we're assuming that confidence is going to start to move forward. Now, the other thing I want to mention here is the fact that the consumer is in very good shape. You can see household net worth is up $25 trillion or 21.3% compared to pre-COVID levels. This is not what you see during into and through a recession. It's at these levels at the moment because of 3 things: record home prices, record financial markets, but also consumers have accumulated $2.5 trillion of excess savings above and beyond pre-COVID levels. And there's a viewpoint out there that all of this has accumulated to the top quartile. But recent Fed papers suggest that it's actually pretty evenly distributed. In the bottom quartile, they have about 15% of this savings glut. The middle 2 quartiles have 45% combined, and that top quartile does have the lion's share at 40%. But this is a really important dynamic and finding because the lower quartiles have a much higher propensity to spend that money. So in our opinion, this is going to be a nice driver of consumption over the next couple of years. Now, certainly there's been people that have not participated in that household net worth chart, or they spent all of their fiscal stimulus, but that's not a concern either because credit spigots are wide open right now. We got a new senior loan survey released yesterday for the third quarter, and you saw a drastic easing of standards of lending from the banks for consumer loans, in particular credit cards. So again, banks are flush with cash. They're very willing to lend right now. It's really been demand that's been tepid and why we haven't seen greater credit creation. But I think this is going to be more and more of a story in 2022. It's not something we're concerned with because consumers aren't over-levered, but certainly going to be a core underpinning of that consumption story. The other part of the consumption story has to deal with the labor markets. And you have an insatiable thirst for labor right now. On the left-hand side, job openings aren't at record levels anymore, but they're still at a very robust 10.4 million, which was 3 million above the pre-COVID peak. Right? So there's an insatiable demand for labor right now, and there's a view right now that the jobs aren't coming back. Think about last cycle, right? How many times did we hear that the jobs aren't coming back during the great financial crisis? And the jobs eventually did come back. All right, because the economy finally healed and it proved not to be structural. And in the current environment, it's a similar discussion, but it's a funhouse mirror. It looks a little bit different. The reason why people are saying that jobs aren't coming back is because the workers aren't coming back because the supply side of the economy has been permanently altered. But I don't believe in that narrative. If you look on the right-hand side, 8.5 million people have lost their federal unemployment benefits. And if you look at middle-income households, they've increased their cash holdings from roughly 10% to 20% of after-tax income, which is equivalent to about 2 months of take-home pay. And those that are currently not working, they're going to burn through those cash cushions relatively quickly, which is why we expect a lot of the labor force dropouts to return before the end of the year. And if the October jobs report is a sign of things to come, we are going to have a very good fourth quarter with the jobs report, including revisions to previous months, coming in at over 750,000 jobs created. Also, I think as we move past peak Delta, a lot of people that are concerned about getting the virus or people that are home with their kids because of irregular school schedules are going to transition back into the labor market as well. And the biggest driver of consumption is not fiscal stimulus. The biggest driver of consumption is compensation. And with wage growth at 4.9% on a year-over-year basis and people working close to record hours per week, that's a very strong compensation number. And I think, again, combined with household net worth is really going to underpin the consumption side of the story for the economy over the next couple of years. But another part of the economy is going to really heat up and add to GDP in 2022, and that's businesses. And that's going to take a form in two ways. First, we're already embarking on a massive inventory restocking cycle. And with third quarter GDP coming in at 2%, if it wasn't for inventory restocking, it actually would have been a negative GDP print. So it's now finally starting to be a tailwind to GDP rather than the headwind that we've seen throughout 2021. But again, we think that this tailwind continues over the course of the next 5 quarters. But maybe more importantly, Capex is going to be very strong this cycle. I'd argue that this is going to be the strongest Capex cycle that we've seen since China joined the World Trade Organization back a couple of decades ago. One of the reasons I say this is because Capex follows earnings with a 1-quarter lag, as you can see from the chart in front of you. So there's certainly the capital to be able to invest in themselves. Secondly, there's a really strong correlation between the Business Roundtable CEO survey and Capex. And looking at the most recent output, this suggests that Capex is going to get to 20% on a year-over-year basis. Also, we haven't had a Capex cycle in a long time. Stuff in the U.S. is old if you're looking at the average age of a property or plant or equipment. But maybe more importantly, if you look at the Tax Cuts and Jobs Act back in 2017, one of the key things of that was 100% expensing of capital equipment. And that's going to expire at the end of 2022. So a lot of savvy corporate managers are going to want to kitchen sink their investments into next year to be able to take advantage of that tax situation. But last thing on Capex is we're in a new world right now. We're in a world where a lot of corporate managers recognize the vulnerability of their supply chains, and they're only as strong as its weakest link. So there's going to want to be a push to make these supply chains shorter and more reliable. But also, you have demand, and we haven't had demand in quite some time. I mentioned U.S. consumers having $2.5 trillion of excess savings. Global consumers have $5 trillion of excess savings, and corporate managers are going to want to take advantage of that demand as we come out the other side of COVID. So putting this all together, this is expected to be the best year of GDP growth that we've seen in the U.S. since 1984. But it's not just a one-year phenomenon. If you look out to next year, expected to be the best year of GDP growth since the year 2000. Now, we're more optimistic about next year's GDP growth. We think it could come in closer to 5% for a couple of different reasons. First off, if you look at the auto situation, if auto production just gets back to normal, no longer a headwind to GDP, but a tailwind to GDP, that alone could be a swing of about 3 or 4 percentage points of GDP growth rates. Also, I don't think we're going to see a disruptive winter wave of COVID. Delta hit a lot later this year than what you saw with the wave going into 2020's winter. Also, about 65% of Americans have gotten at least one vaccine already. Also, there's a lot of people that have natural immunity. Over 25 million positive COVID cases have been reported year to date. And I think maybe most importantly, it's going to be very difficult to outcompete Delta, right? If another variant's going to come into the situation, it's going to be more dominant than Delta. It has to be more contagious than Delta, more vaccine resistant than Delta. And given how strong Delta was as a variant, I think it's going to be very difficult to replace it. So long story short, I think we've seen the last disruptive wave of COVID. You look back to all the pandemics over the last century, they've had around 4 waves each, which we've had here in the U.S. They've lasted around 2 years, which we're rapidly approaching. But also, we've learned to live with the virus. And we're in the final stage of reopening where kids are going back to school. People are going back to the office. You're going to see a pickup of business travel, which I just came back from a business trip literally yesterday. You're going to see a more durable spending on the services side of the economy. Also, which I think is a game changer, last Friday, the results for the Pfizer COVID pill came out, which is it's an antiviral pill that's available over the counter, so it's like a Tamiflu pill, cut hospitalizations by 90%, and virtually eliminated the risk of death. There was no deaths in the trial out of the 775 adults. So again, this is going to go a long way to getting those that are not going to get vaccinated help, and it drastically reduces the mortality of the virus, which again is the key thing in what's been holding up economic activity. So in looking at the 2022, I'm envisioning a much more stable year of economic activity. We're not going to have these fits and starts, but I also think given all the positive dynamics that I just mentioned, you could see the economy come in above expectations, and that's going to drive better earnings. Now, looking over to the markets really quickly, if you were with us last quarter, you'll remember this slide that we thought that the markets were maybe had a higher probability of some sort of consolidation, because during a new bull market, this is the point of the time where you see a consolidation and some sideways market action. And we got our first 5% correction in over 226 trading days, which is the 7th longest stretch in history. Now, one of the reasons why we felt that it wouldn't be a very big correction, something approaching 15 or 20%, is because retail sentiment, even though the headline indices were only down 5 or 6%, had completely reset. One of the ways to gauge this is the AAII survey, the gold standard in retail sentiment. And the sister dashboard to our recession dashboard, which is the recovery dashboard, this is one of the key variables that we have in it. It's a contraindicator. So when you see a lot of bearishness in there, that means that you're close to a tradable low. And the bull-bear ratio got to -17 in early September, which were levels consistent as with what we saw going through the recession and in its aftermath. So again, there's a lot of negativity already embedded in the market. Also, what I think bears mentioning is that a lot of the market has seen a rolling correction over the last couple of quarters. Even though the headline indices held up well, there was a lot of companies that were down 10, 20% if you looked underneath the surface. There were a couple things that we didn't know that we now have some visibility on. The first is whether or not the retail put would come back into the equation. And this is a jaw-dropping chart, right? If you look at global equity inflows over the course of this year, it's been $756 billion. If you look at the 2.5 decades prior to it combined, this was 4 times the amount of inflows. So the retail investor has very much been putting their money to work in equity markets, and we may be embarking on the great rotation from bonds to equities that people have been touting for the last 15 years. But again, would the retail investor buy the dip? Well, they certainly did, and again, this is a key reason why the markets have moved higher. The second thing that we got visibility on was third quarter earnings. You can see that earnings surprises since the pandemic have been averaging around 19% versus a 2% average beat over the prior 2 decades. So this has been really jaw-dropping. But you can see here that the earnings beat is not as high as what we've seen, but it's still at a very robust level of 9 to 10%, depending how things pan out. Now, I'm going to turn it over to Josh here for a couple minutes to talk about what he's seeing in the third quarter earnings season, but also what we're expecting as we look out on the horizon. So, Jamner, take it away.
Thank you, Jeff. As you just mentioned, we're at the tail end of earnings season. It's just over 90% of the S&P 500 as reported by market cap. The last bit should trickle in over the next 2 to 3 weeks. It's always kind of a long tail at the end. There's a couple companies that take their sweet time. And we've seen really strong beats, a little over 10% right now. Whether it ends up at 9 or 10 remains to be seen. Just under 80% of companies are beating expectations, and it's been a little bit skewed, to be honest. Financials have seen really strong surprises on the back of better loan loss provisions. Financial sector has about a 19% beat rate, but if you look at the S&P 500 ex financials, so everything else, it's still very strong. It's in the high 8s, maybe low 9%. Earnings growth is very strong, just under 40%, and revenue growth is also very healthy, about 16%. So this means margins are substantially contributing to earnings growth. I think one thing that stands out is that growth stocks relative to value are seeing better top line or revenue growth, but there's much stronger margin contribution from the value side of the equation, and so they're seeing much stronger earnings growth. And just to put that in perspective, on a year-over-year basis, the value benchmark is 49% earnings growth relative to 27% for growth. And given that dynamic, it's probably not surprising what I'm going to say next, which is that surprise within value is stronger than growth. So given that more upside coming from margin, which I think typically analysts have a little bit more difficulty modeling. One final note when we're talking about the third quarter before I start to move into what might come next quarter is that there seems like there's been a lot of blow-ups this earnings season. There's been some really high-profile names that have been trading down 15, 20, even 30% or more in some cases following misses. But when you run the numbers at an aggregate level, things are actually kind of normal. Companies that are beating on both the top and bottom line are outperforming by about 1%. It's a little bit less than normal, nothing crazy. And similarly, companies missing on both the top and bottom line in aggregate are lagging by about 3%. So a little bit more than normal, but this isn't anything wildly offsides, and it's starting to renormalize relative to the last couple quarters. As we start to look towards the fourth quarter, expectations have been holding steady. Coming into third quarter reporting season, we were expecting the bottom-up consensus was for 20% earnings growth, and that's virtually unchanged. We were within 0.2% from where we were about 6 weeks ago when earnings season kicked off. When we look at the possibility for surprise, I think that there's continued. I think it'd be reasonable to continue to believe that we're going to have more upside coming from the margin line, probably stronger reporting from the value side and the cyclical side. And I'm not a bank expert. I think loan loss provisions probably won't happen forever, so we could see this kind of beat rate normalize towards something in the high single digits. It's going to be above historical averages, but probably below the recent trend. And I think that could be a good thing as we think about stock market response. Probably see more differentiation, maybe more both positive and negative price performance tied to beats and misses. I'll turn it back over to you, Jeff.
I think Josh is foreshadowing our call a little bit later in the presentation with some of those comments. One thing I'll mention again, with GDP now at 8.2%, you put a 5% GDP price deflator, i.e. inflation on top of that, you're going to have double-digit nominal GDP growth in the fourth quarter, which again I think is going to really keep this surprise trend that we've seen continue, especially above the long-term averages. One other thing that I didn't mention and we don't have a slide for that's been propelling the markets higher and we have visibility on is the fact that the tax increases that were expected for corporations aren't going to be nearly as bad as anticipated. Statutory taxes looks like it's going to remain the same. The GILTI or the overseas income taxes is going to be less than expected, probably going to come in at 15%, probably not going to be instituted until 2023. But also you may see a 15% minimum tax rate on U.S. companies, which will affect about 50 companies in the S&P 500. But again, much less of a headwind to next year's earnings profile than what was initially anticipated. Now I'm going to move over to the trillion-pound gorilla or elephant in the room here, which is inflation. Josh talked about inflation last quarter, so it's my turn to talk about the hot topic. And we got a hot inflation print yesterday, if you were paying attention to the CPI numbers. And there was no silver lining in that CPI print, right? There's a million ways to slice and dice CPI, and they were all up and to the right, right? If you think about core is at the strongest levels that we've seen since 91. Headline, strongest level since the year 1990. You saw rent inflation move up by 0.4% on a month-over-month basis, which is confirmation that this is a higher trend. And this is something that we've been anticipating because if you look at rent inflation, it actually lags housing prices by 15 months. And really when you started to see housing prices move up parabolically, it was 15 months ago as we were in the late summer of 2020. Also, medical care services is going to be a stickier source of inflation, at least until we get to the middle part of August. And used cars, defying gravity, continue to move higher and are contributing to inflation. So yes, there's no silver lining on it, but we do think that inflation is going to come back down and going to come down to levels that people are more comfortable with by the second quarter of next year. And by the end of 2022, looking at core inflation, whether it's PCE, for example, which the Fed looks at, I think we can be closer to 2% Fed's target. One of the reasons why we say that is the base effects. If you look at the slide in front of you, small groups are providing an outsized influence on the core numbers. And if we look at used cars, for example, 4.3% weight in core inflation, core CPI, they've contributed 26% to the total increase of core CPI on a year-over-year basis. And if used car prices stay flat, which I would have said is a given 2 months ago, maybe not, but if they just stay flat, it's going to shave 1% off of core CPI alone. So base effects are going to be very difficult to keep these higher inflation numbers up forever. The other thing I'll mention, in order to see sustained inflation, you need to see price levels accelerate continuously. right? And that means supply shocks need to be perpetuated, they need to be sustained, or the demand curve needs to keep rising continuously, or both. And talking about the supply chains, I think you're going to see normalization in 2022 for 3 reasons. First off, you're going to see improved chip supply, right? A lot of the factories in Asia have restarted here, and you're going to see expanded production capacity as we move into the second half of 2022. Speaking about Asia, the world's manufacturing engine, vaccination rates are going to reach levels that are associated with quote-unquote herd immunity. By the end of the year, 11 out of 12 of the countries in Asia, representing almost all of the region's GDP, are going to reach 70% adult vaccination levels. Out of those 11, 9 could achieve rates that are upwards of 90%. So they don't have the vaccine hesitancy that we have here in the U.S., but again, that goes a long way to keeping those supply chains moving forward. Also, a lot of these countries have abandoned their zero-tolerance policies, and they're not shutting down their economies anymore. The other thing that I'll mention is, of course, the improved labor supply in the U.S. As I mentioned earlier, I think a lot of people are going to burn through their cash savings. They're going to come back into the labor market in the next couple of quarters, but also, as we learn to live with the virus, we have this COVID pill from Pfizer coming out. You have a full reopening and more engagement with services. People that are scared of getting COVID or at home because of irregular child care schedules, which is about 3.5 million people, they should transition back into the marketplace sometime over the next couple of quarters as well. And the third thing is we're going to see a wind down of U.S. port congestion. Now, obviously, it's not going to happen anytime soon, but one of the things that's happened just recently is one of the reasons why they can't unload these ships is because they have empty containers all over the docks. And the mayor of LA recently said instead of being able to stack 2 of these containers high in the trucking areas, you can now do it up to 5. So that's just one situation that's being alleviated to help the ports. But I think maybe more importantly is you're going to see a lot of a reduction of port congestion as we get past the busy U.S. holiday season and the pre-Chinese New Year's shipping windows. Very slow time at the ports as you get through this time frame. So you're going to see some port congestion reduction probably by the second quarter of next year. Maybe most importantly, as we have a more durable economy, you're going to see a substitution from buying goods back into services, right? And you could have actually had some pull forward of goods demand, which you're going to get payback, and we get into 2022. And this is going to happen at the same time as all of the supply that's waiting off ports comes into the U.S. So lower demand, a lot more supply. You could have outright goods deflation in 2022, which could help offset some of the services inflation that you're going to see, and also some of the shelter inflation that's going to be sticky over the next year or two. So our core view is inflation is going to be uncomfortable. It's certainly going to be uncomfortable when we get the November print. This isn't going away in the next couple of months, but as we get to the second quarter of next year, it's going to become clear that a lot of these supply chain bottlenecks are going to be alleviated. The labor market's going to be closer to equilibrium, and we see the inflation rate going back towards the Fed's 2% target on a core PCE basis by the end of next year. Now, one other reason why you shouldn't maybe be concerned, and I completely skipped this slide, I apologize, about the supply bottlenecks, but one of the reasons why you probably shouldn't be concerned longer term is that the markets are not concerned longer term. Markets, if you look at the next 5 years, which is that blue line, are pricing in higher inflation at 3%, but as you get to the back half of this decade, which is the gray line, they're pricing inflation coming back down to the Fed's 2% target. So if the markets aren't that concerned about inflation, and yesterday when we got that hot CPI print, five-year break-evens did not move higher. They're actually flat on the day. Again, the markets are looking at this as a transitory, but a little bit more protracted than anybody had anticipated when we were having this conversation about 9 months ago. So with that, I think I've talked about inflation long enough. I'm going to turn it over to Josh to talk about the Fed and maybe the response and the path that the Fed's going to have here over the next couple of meetings. So Jamner, take it away.
Sure. I think before I jump into the Fed, do you want to talk about the margin side of the equation?
Sorry. One more comment from me. Inflation is actually not necessarily bad for companies in aggregate or the indices on aggregate. They're certainly bad for certain companies, depending whether or not they're price takers or price givers, how much operational leverage they have in the individual dynamics of that industry. But higher inflation is, generally speaking, good for earnings. And maybe a good way to show this is operational leverage and its impact on inflation. So we took a hypothetical company here, $100 in sales and 10% inflation. So sales rose by 10% to $110. It's a 10% EBIT margin company with a 50-50 fixed to variable cost mix. And in this situation, expenses are going to rise from $90 to $94.5, but also net income is going to rise from $10 to $15.50, which is an increase of 55%. So I think there's a view that inflation's necessarily bad for companies, but again, we're in a dynamic where we have high inflation, but we're also having very, very strong growth right now. This is not the stagflationary 70s. If you look at compensation, for example, compensation is well above the levels of inflation that we're seeing. So you're not going to see demand destruction, which is one of the reasons why high inflation could be bad for companies. And I think it's a key differentiator between what we're seeing today and what we saw just 5 decades ago with the higher inflation 1970s. So again, operational leverage is an attribute that we've been looking for at ClearBridge for companies to have, and it's obviously been one of the reasons why third quarter earnings continue to surprise to the upside, which will likely bleed into the fourth quarter as well. So with that, I'm going to turn it back over to Josh to talk about the Fed.
Thanks, Jeff. I think the other reason that inflation has been such a focal point for investors is that how we think about, how could inflation impact the path for Fed policy. If you want to go to the next slide. In turn, Fed policy is going to impact interest rates, equity valuations, and also equity market leadership. Given everything you just laid out around inflation, we've seen a shift even just over the last 5 to 6 weeks, really the last month, for the market expectations for Fed rate hikes. On the chart here, we're looking at the 3-month Eurodollar futures market, which tends to have a little bit better liquidity when you move out beyond 12 or 18 months relative to Fed fund futures, which are kind of a more pure pricing on Fed rate hike expectations. But in truth, Fed fund futures show something extremely similar to the Eurodollar futures market, which is that expectations for the liftoff, or kind of the initial Fed rate hike, have been pulled forward to somewhere around the midpoint of 2022, and also a steeper path of Fed rate hikes once they do get off the zero lower bound, with something like a little over 2 hikes right now priced in 2022, and another 3 hikes priced in 2023. And this is, as you can see on the blue line, a earlier and steeper path over the first kind of 2 years relative to even where we were at the end of the second quarter at September 30th. But then interestingly, the market's kind of pricing in a pause or a flattening out once we get beyond 2023. So when you look out to 2024, 2025, the market's now pricing that basically the Fed stops. There's only one more hike priced in to the end of 2025. So kind of a pull forward in policy given the risk of higher inflation, and then the potential for the Fed to back off. And you might hear the words totem hikes is kind of something that's been floated. I think it might be a phrase that we hear, like as Tim was talking about. If last year was unprecedented, this year was transitory. I don't want to put too much money on this one, but totem hikes could be one of the things that we say way too much as we move into 2022. And thinking ahead, the market is pricing this more hawkish path for Fed policy, than what the Fed themselves has laid out. And whether you look at the Fed dots, or one of the things I really like to focus on actually is what's called the Fed staff projections. This is the materials that the economists at the Fed, and the Fed is the largest employer of economics PhDs in the world, this is what they use to kind of have the discussion at the FOMC meetings. And they release it. It comes out as part of the Fed minutes in a couple of weeks after each of the meetings. And regardless whether you're looking at the dots or the staff projections, the market basically thinks the Fed's going to blink. We have this kind of stronger inflationary backdrop that Jeff laid out right now. We think, and the Fed projections and the dots also show that it's going to cool down as we move into 2023, 2024. And the market's sort of saying, well, the Fed might have to raise hikes, and then we'll back off as things slow down. I think it's important to remember a couple of things. One is that the market's track record of forecasting Fed policy has been very hawkish for most of the last cycle. Doesn't mean that they won't be right, but the historical track record of market expectations relative to dots or staff projections isn't all that great. Nobody knows what's going to happen in the future, so I don't think we should put too much emphasis on any one of these things. And the second is that the makeup of the Fed, the FOMC specifically, is about to shift. There's several open seats on the FOMC board itself, as an addition to the open regional governorships. We've had several more hawkish members left or will be leaving over the next few months. And, we don't have any unique insight on how this is going to play out, but I think it's pretty reasonable to assume that the replacements for these open seats are probably going to be slightly more dovish relative to their predecessors. And so when we're going to have to kind of wait and see how it plays out, candidly, but this is the kind of framing and context that we're using to think about it through. So the reason that I mention this is that, interest rates and the expectation for what the Fed do is one of the more important things when we think about equity market leadership. And this has been really the case over the last year and a half. When we look at the trade between growth and value, which is the gray line shown, it's been moving more or less in lockstep with the 10-year Treasury, which is the green line. Now, the bond market's closed today in observance of Veterans Day, but stocks are being led by value relative to growth, which would suggest if the bond market were open and this holds up, that rates maybe would be coming back down a bit after the really big move higher following the hot CPI print. Now, if we think longer term, if we think the 10-year is likely maybe at 155, I think is where it closed yesterday, 154, there's risk to the upside to that number. This would suggest another leg in the value trade could play out. It's not just interest rates that are one of the reasons that we think that there's an opportunity in cyclical or value stocks, and I'm going to use the term synonymously, even though that's probably imperfect, but just for the sake of making things a little bit easier to talk about on the call. I'm skipping ahead. I apologize. I jumped ahead to the next slide. Sorry. But if you look at just kind of going with this idea that interest rates have been one of the major drivers between cyclical and value stocks, cyclical stocks or value versus growth, it also plays out at the sector level. If you look on the left-hand side, during the period where we had a declining 10-year Treasury yield starting at the end of March and then running through the early part of August, we had fairly defensive leadership, things like tech, healthcare, commercial services leading. Hasn't been a perfect reversal nor a smooth path higher in rates since the beginning of August. But on the right-hand side, since that low in Treasury yields, the better performing sectors tend to be the more cyclical ones, things like energy, financials, consumer discretionary, that are more tied to economic growth and interest rates. Now, moving beyond just the interest rate backdrop, and this is what I was starting to jump ahead to, the fundamental case, I think, for cyclical and value is also pretty intact. Value has had superior earnings growth so far in 2021. That's expected to be the case in the fourth quarter, and also in 2022, which is shown on the right-hand side of the slide. And then further, valuations continue to favor value. Now, growth tends to trade at a premium relative to value, but this gap is even more exacerbated right now than normal. It's about a little over 2 times the historical average discount that you get. So, value stocks and cyclicals are offering better growth, more favorable valuations, and could benefit from higher rates if that happens to be what plays out. So in the near term, we think that there's still an opportunity there. Admittedly, this has been a pretty painful call for us over the last 6 months. It certainly did better in the 6 months before that. And with that, I'm going to turn it back over to Jeff to talk about other areas that we see opportunities as we move into the new year.
Thanks, Josh. And your comments on third quarter earnings certainly foreshadowed that viewpoint. But one area that I think is being overlooked right now is small and mid caps. Generally speaking, when you come into a new economic cycle, small and mid caps lead for the first year, the second year, and the third year. And we've had a little bit of a different dynamic so far here in year 2. We'll look at small caps on the left-hand side, and that second to right column, you can see that small caps usually outperform their large cap brethren by 4.3% on a relative basis. Today it's 5.6% negative. In fact, if you look at valuations of small versus large, they're close to historic extremes at the given moment. So if you look at third quarter earnings, it started off with large caps outperforming small caps, but small caps have gotten a bid here over the last couple of weeks because their margins have held up much better in a high inflationary environment, which traditionally large caps have much more pricing power and levers to be able to offset inflation. But again, this could be the beginning of a move more durably into small cap leadership. Similar thing with mid caps. Again, lead for the first 3 years of a new economic cycle. Mid caps have actually underperformed large caps by 3.1%. So if you've had a large cap overweight in your portfolios from a U.S. perspective, that's been great. But we do think that there's an opportunity, at least over the next 6 to 9 months, especially with a very robust GDP backdrop, that small and mid cap leadership could start to reassert itself in a more durable way. And the last thing I'll talk about here is a risk that I'm sure a lot of you are thinking about here recently, is the downturn that you've seen in the Chinese economy. There's a lot of concern about the property market causing a financial shock, and we've seen 3 other Chinese downturns in the last decade. which were in 2011 and 2014. And this is the third one here recently. But more importantly, if history's any guide, housing prices just went negative about a couple of months ago. Usually authorities will let housing prices continue to decline for about 6 to 9 months before turning on the credit spigots and also to reaccelerate the economy. But the key here is, if you look at the credit impulse, we're at levels that are consistent or even lower than the last 3 down cycles that we've seen in the Chinese economy. And even though we're probably not going to get a U-turn quite yet, as we get to the fourth quarter Politburo meeting, that could start to signal that they are going to start to loosen up the monetary spigots and also provide more fiscal stimulus. And one of the reasons for that is policymakers may want to provide stability ahead of the 20th Party Congress next fall, where Xi is likely going to step into an unprecedented third term as the premier over in China. So again, you're starting to see this affect a lot of emerging market economies, a lot of economies that are dependent on Chinese growth. But this is something that we're watching very closely for the turn of the global cycle. And quite frankly, this could be a reason why the 10-year Treasury has been a lot lower than what people are anticipating at this given point. So that's all the prepared comments that we have. Maybe I'll turn it over to you, Tim.
Yeah, it's perfect timing, Jeff, because we just got a question from Jeff in Virginia, who wants to know, should we be rethinking our portfolios? And he gave us a couple of options, commodities, real estate, gold, value versus growth. Any others ideas that you may have?
Yeah, I think we touched on a lot of these, right? I think you want to think about smaller capitalization in your portfolios at this point, given the outperformance that large caps have had. I think you want to have value over growth, definitely cyclicals over defensive areas of the portfolios. From a commodity perspective, since China is such a large commodity consumer, the fact that their economy is not accelerating quite yet, I don't necessarily think now is the right time to have an overexposure there. I think as we get to next year and we get some visibility on what Chinese policymakers want to achieve, that could be a good opportunity to leg back into that trade. But I do think there is an opportunity in oil right now, given the fact that OPEC is being very, very consistent with only bringing on 400,000 barrels per day. Also, U.S. production is being curtailed. You're seeing a lot of discipline with the shale operators. I mean, production in the U.S. is about 2 million lower than its peak production. But also, you're going to start to see the global economy come on demand. The demand is going to come on much more robustly. But China's really going to be the key to that, because they are having 13 million barrels per day of use back in the middle part of last year. They're down to about 10 million. So I think China's going to really determine how high oil will ultimately go. But right now, it's in a deficit, which is usually good for that particular area.
Great.
Josh, you have anything else to add?
No. I think the one thing I might mention is that when it comes to some of these ideas, the time horizon matters. So, not to foreshadow too much, but I think if we're doing, this call in 2 quarters from now, some of these views might change. The market has been very responsive to COVID for the last year and a half, and there's no indication that that's changing. That's continuing to play out. We're going to continue to kind of monitor that and think about it. But when it comes to some of these ideas around cyclical defensives, for example, given the views that we've laid out around inflation slowing in the back half of next year, that could lead to kind of different recommendations as we move there. So I just wanted to mention that time horizon component to all of this.
Great. Well, we've had a bunch of questions about supply chain and the port issues that you brought up. One of the questions I thought was pretty interesting, and I'll send this over your way, Josh, is what do you think do you think self-driving trucks could help the port situation, and how far in the future do you foresee that?
I am not an autonomous driving expert. It certainly couldn't hurt. I don't think it.
But you did stay at a Holiday Inn Express.
Exactly. Obviously it would help. I don't think it's going to happen in time for the current supply chain bottleneck to be, a material impact. I think, as Jeff laid out, the ability to start stacking containers higher should help. And I think probably it's important to remember, and I know that I pulled this chart back up because it wasn't on the screen for very long. We have it's a good thing. There's a demand problem in that demand is so strong that port capacity is not able to keep up with this robust demand. So the number of containers unloaded in the port of LA is what's shown on the screen. If you include Long Beach, it's in the mid to upper teens. I forget the number off the top of my head. I think it's about 18%, 19%, something like that, above pre-pandemic levels. So we have so many containers coming in that this backup is happening because it's not that the ports aren't operating, it's that there's so much stuff coming, they're not even able to keep pace. The reason that I think that's important, and Jeff kind of alluded to this, is that as we move past the Delta wave, as we move from a kind of a pandemic into an endemic stage, and life continues to renormalize, individuals continue to re-embrace services at the margin. That should lighten up goods demand, which means there should be less stuff coming in. So one of the things that we talked about, if we were doing this call a year ago, we would have said, you can only redo your home office so many times. You don't need to buy another office chair. At some point, that demand should start to slow. And on a personal note, the three of us are sitting here in a conference room doing this together for the first time in 2 years, which is a nice thing for the three of us. But we're starting to see elements of that play out. There's been fits and starts, and Jeff did talk about this. Delta really materially changed the course that we were on, and Fed Chair Powell talked about this in the FOMC press conference last week. We were on one path in kind of April, May, June, and then Delta happened, and part of the reason that this transitory has become elongated is because of Delta really threw a wrench and just stretched the time frame out. So I know there's this sort of like transitory versus permanent dynamic going on out there in the marketplace, but I think the truth is probably somewhere in the middle. It's sort of like transitory with, as Jeff talked about, underlying increase from services with a monkey wrench thrown in by Delta, and it just makes this really messy situation. But related to ports, I think that ultimately these issues, it's unlikely that we'll be talking about them. They're not going to go away, but I don't think it's going to be the focal point 6 months from now, a year from now. And we're already seeing prices start to come down, which is a positive thing.
Good.
And I think it's an important question, right? Because a lot of times these truckers were able to grab 2 loads from the port and deliver them, and you get paid per load.
Right.
And traffic jams are so bad that they're only able to do 1 load. So again, it's a great question.
Right.
But I think it's a myriad of different things that are affecting the ports, and certainly could help at the margin, but we'd still be in a port congestion situation anyway.
All right, this is for you, Jeff, since you brought it up. Jim from Ohio says household BS, and I think he means balance sheet, seem to be historically healthy. Does this mute the Fed's influence?
Well, I think it amplifies the Fed's influence in creating greater aggregate demand for the economy overall, right? Balance sheets haven't been this good in 4 decades, I would make the argument. And the Fed keeping it policy so loose is just going to amplify this cycle. And I think it's a key reason why we've been blessed with having 10-year economic cycles since the early 1980s. And this time around, I think it's probably going to be a 5 or 6 year economic cycle, because you just have a very loose Fed, you have a very strong consumer, you're seeing very rapid gains in the jobs market, and we're going to run up on the terminal value of where the economy is going to run fairly quickly this time around. But no, I think the Fed is doing what they should be doing. I mean, last cycle they got the unemployment rate down to where they wanted to get it, and you saw inflation expectations dropping, right? You can fight inflation, you can't fight deflation, which every other major central bank in the developed world has learned. So I think they learned an important lesson, and they want to make sure that they are ahead of the game and they have inflation and they have the tools to fight that. Which is why they're keeping the foot all the way down on the accelerator. So, yes, I think Fed policy is still very much effective, and I think it's going to prove to give the Fed a little bit more breathing room this cycle than what we've traditionally seen recently.
Question for you, Josh, since you're the only one that mentioned transitory in your comments. Dave in Texas writes, supply chain seems to be every retailer's excuse for price increase. How sticky do you think these price increases will be?
I think it varies, very industry specific. I agree. It is the common excuse. It reminds me of a couple of years ago when the dollar was moving around a lot. That was a very popular excuse. I don't want to knock corporate management teams, but there's one well-known instance of a tech company that does not touch goods whatsoever, saying supply chain issues were, the reason that it was like, I hate to say, are you kidding me? But that was the market sussed that out, and the price reflected that. I think corporate management teams either can deliver. I'm stealing this line from one of our portfolio managers. Management teams can either deliver results or excuses, and I think in some cases it is certainly an excuse. I don't want to oversell that it is just an excuse. There are, as Jeff talked about, increasing inflation in services, particularly rents, is not going away and is going to be with us for some period of time. Medical care, I think, is another area that we're going to be talking about 6 months from now as a source of rising inflation. But on the good side, I think we're going to start to see some of these things come down. I mentioned shipping prices are coming down. When you look at commodity prices, one of the biggest worries was that we've been seeing very strong rising input prices in the form of higher commodities. When you look at industrial metals, things like nickel, aluminum, I don't know if any of you have pulled up a chart, some of these commodities are down 20, 30, 40% over the last 6 weeks. Part of that is a China-specific story, but part of it, I think, is when you extrapolate into where we might be in inflation 6 months from now, a year from now, we're going to start to see some of these, really strong rises in certain areas and goods start to come down. Jeff, I don't know if you have anything you want to add or.
No, I think we covered it pretty robustly. So.
Okay. Here's one that's more general in nature. What level of sustained inflation would be considered a headwind to economic growth?
I think it comes down to where wage growth or total compensation is. As I mentioned before, compensation is quite healthy right now. Again, one of the reasons why you've had stagflation is you had demand destruction as people weren't making enough money and they were waiting for goods prices to come down. So as long as you have strong inflation, but that's coupled with strong economic activity, which is the backdrop we have today, I think inflation can be at these higher levels and really not affect the U.S. economy, but also affect the earnings potential of a lot of these companies. But, if we're talking about, 3.5%, 4% inflation, core inflation, a year and a half from now, again, there's only so long that you can continue to have these higher wages before it starts to affect corporate profitability and productivity and unit labor costs can't keep up. So I would say 3.5% for me personally on a core basis would be something that's concerned. I don't know.
I think the level of real growth is another consideration. If we're talking about 3% inflation and a 1% real growth rate, or 3% inflation with a 7% real growth rate, those are obviously two very different things. When we look at nominal GDP growth right now, we're in the low teens. Not this past quarter, but on kind of a year-over-year basis or a trend basis. And so, are we talking? What is your view of trend real economic growth is just an important part of the conversation that I think is.
So drilling down on that a little further, Alexander asks, how severe is a drag on higher energy prices on U.S. and global growth?
Yeah, so let's take $80 oil, for example. In the U.S., back when we had $80 oil back in 2014, U.S. consumers were spending around 3.5% of their wallet share on oil. Today, they're spending about 2.5%. Because incomes are up a lot more than where we were just 7 or 8 years ago. So it certainly has an effect to consumer spending. But again, given where compensation levels are right now and all the momentum that we're seeing in the jobs market, it's really going to slow it by maybe a couple of tenths of a basis point, 20, 30 basis points, but nothing enough to significantly slow it to levels where I see concern, at least here in the U.S. And then if you look over in Europe, for example, nat gas prices are down significantly, 30, 40% from levels that we've seen. Over in China, you've seen coal prices drop very dramatically. So it does appear that the squeeze that we saw over there is just a temporary phenomenon. And if we get a colder winter, obviously you can see those areas increase. But again, it's going to shave maybe a little bit more off of GDP of 30 or 40 basis points. But again, given all the momentum that we have here, it's a minor headwind.
I just add, I think that the relationship has dramatically changed over the last decade for a couple of reasons. When you look at the two biggest things that people in the U.S. spend, where energy comes, right, it's driving a car and heating your home, and the efficiency, like the fleet average miles per gallon in the United States is up, I forget the number off the top of my head, I think it's about 33%, 35% over the last 10, 15 years. So, the impact of $1 more gas is less when you have a more efficient car. And then same thing, when you look at the efficiency of a new, furnace or boiler in your house, it's pretty dramatically different relative to what was going on. So the energy intensity or the efficiency in the United States has been improving, which means that, each higher dollar of oil or nat gas is a smaller and smaller impact to the consumer. And then the other thing is, because we have had a pretty dramatic rise in domestic energy consumption over the last, really 20 years, the relationship when you talk about, what it was like in the 70s versus today is pretty dramatically different. And when you look at the relationship between energy prices and consumption in the United States, it used to, the slope has changed. It used to be a negative relationship. It's now a positive relationship. So it's not, I don't think that it's, if we were to go to $150 oil tomorrow, yeah, that would be a problem. But I think even if we're at 80, 85, or I forget exactly where we were on the last couple of days, but we could go towards 100, even 120 over a kind of a couple of multi-month period without it causing a huge problem.
And one thing I'll say, just for us to get back to how much of our wallet share we're spending, back in 2014, oil would need to be $110 a barrel. If we go back to the highs that we saw in 2008, oil would have to be at $252.
Oh.
So let's
keep our fingers crossed we don't witness that. We're in the speed round portion. Zach in New York asks, grade the EU central bank versus the Fed.
EU central bank had a huge policy mistake back in 2011 when they rose rates, shut them back dramatically. You've seen inflation expectations get embedded to the downside there, and it's going to be very difficult for them to break that mentality now. Obviously, demographics are much worse over in the EU. Their banking system was much more levered, so they had a bigger hole to dig out of. But I think the Fed, if I'm going to give a grade, Fed gets an A+. I would say the ECB doing everything that they can, but I'd give them a B-.
Josh, anything? Well, it was a speed round, so you're precluded from answering. Okay.
Was that even a speedy answer?
That's right. That was a little slow, but that's okay. Jason, here's another part of it. In your opinion, does the Euro futures market have the hike path wrong, or do they have it right?
It's hard to say. I think that it's going to depend on what the internals of inflation look like over the not the next 3 months, but kind of the 3 to 6 months following that. So where are we as we move into the second quarter? Are we starting to see any sign of goods deflation? Are we seeing a handoff back towards services away from goods? What's going on in the labor market? I think the Fed should not have been surprised. Consensus expectation was for inflation to pick up this month. It's going to stay high for the next couple of months. I think one interesting consideration is the Fed going to be willing to raise rates going into the midterm elections is sort of a curious question, and I'm not sure that I don't have a strong view, but the market might be a little bit too optimistic about that potential.
Okay. So we're very close to full time, so before we close, we have one more question that's still in the speed round, so bear that in mind. What is the biggest known or unknown? We each have 2 answers.
I would say the biggest unknown is what policymakers and how much pain policymakers in China are willing to take. If this is a true restructuring, like you saw of this data on enterprises back in the late 1990s, that means it's not time for bottom fishing. You're going to see a pretty big headwind to global growth, quite frankly, over the next couple of years. It's not clear yet. I don't think that's the case, but that certainly could be the purging that they're looking to do after a couple of decades of excesses.
This is going to sound crazy. I think one of the biggest knowns is inflation. We've been talking about it for the better part of a year. We're still going to be talking about it for another 6 months. To my recollection, I can't think of a major issue that caused a major, headache for markets that we spent the better part of 2 years talking about before it maybe, caused a huge problem. So it's a known unknown at this point.
Okay, so that checks both categories. Okay, I think that's about wraps it up. What I wanted to thank all you that tuned in. If there's anything you liked or didn't like or thought we did well or not so well, we would love to hear from you. And if you have any comments, please just send them to me. Send them at twest@clearbridge.com. And from all of us at ClearBridge, thank you for tuning in.